Welcome to the Deep Dive, where we really try to cut through the noise and get to the core of what you need to know. Today, we're diving deep into BTCS Inc. It's a fascinating company, been around the crypto block, so to speak, but now focusing hard on Ethereum infrastructure. And we're going to unpack a really compelling high-stakes question here. Is BTCS, one of the oldest publicly traded crypto companies, actually building the next great digital utility on Ethereum? Or is this whole thing just a highly speculative leverage bet on ETH, maybe destined to get crushed by the bigger fish? Our mission today really is to dig into the verifiable data, management's actions, the market dynamics, basically give you a clear, unbiased picture, the opportunity and, frankly, the dangers ahead for BTCS.
Exactly. And we've put together a comprehensive report for this. All the data we're using is current as of our analysis date, which was July 8, 2025. On that specific day, BTCS stock closed at $2.48 per share. We're going to break this down using a disciplined framework just for you.
Okay, sounds good. Let's kick off this deep dive then. We'll start with Chapter 1 of this analysis. So, BTCS Inc. trades on the NASDAQ capital market, ticker symbol BTCS. And this company, it's really evolved quite a bit since it started way back in 2013 as Bitcoin Shop Inc. Quite the name change.
Yeah, quite a shift. Today, they're laser focused on the Ethereum ecosystem. Their explicit goal, they say, is becoming the leading public company focused on Ethereum infrastructure. They want to be one of the largest public holders of ETH.
Right, and the core of how they plan to do that is this thing they call the TradFi Accretion Flywheel. Sounds complicated.
It does sound a bit jargon heavy, yeah.
Okay.
But the concept is actually pretty straightforward, multi-stage. The whole idea is to grow their Ethereum holdings per share over time. So first, they acquire ETH. They raise money using both traditional finance, like selling stock, and decentralized finance, like, taking out loans on DeFi platforms.
Okay, raising capital.
Yeah. Then they stake ETH. That ETH they buy immediately goes to work in their node ops business, basically running validator nodes, helping secure the Ethereum network, and that earns them staking rewards. It's sort of their baseline revenue stream.
Got it. Buy ETH, stake ETH. What's next?
Then they leverage ETH. This is the clever part, or maybe the risky part, depending on your view. They use that staked ETH as collateral on DeFi lending protocols. Mainly a CA seems to be their go-to. They borrow stablecoins against their ETH and then use those funds to buy, you guessed it, more ETH,
Okay.
which then gets staked and the whole flywheel spins again. So it's the cycle of acquire, stake, leverage, acquire more.
So it's crucial to understand then that BTCS isn't just passively holding crypto like, say, MicroStrategy with Bitcoin. They're not just buying and sitting on it. They're an operating company. Ethereum is both their main treasury asset and the essential raw material for their actual business operations. It's an active strategy.
Exactly right, an active operational strategy. And their main revenue comes under blockchain infrastructure revenue. That includes validator node operations, node ops, earning rewards from their own, 14,600 ETH holdings, plus offering staking as a service for others.
Okay.
But the real growth story they're pushing, the narrative, comes from block building, Builder Plus. This is their proprietary Ethereum block builder. Uses fancy algorithms to arrange transactions to maximize profit, capturing what's called maximal extractable value, or MEV.
MEV, right. That's a whole complex world in itself.
Yeah.
And their key products feeding this strategy are Builder Plus is the flagship tech, NodeOps is the foundation, and then there's ChainQ, an AI analytics platform. Seems a bit secondary, maybe.
Yeah, ChainQ seems like less of the core focus right now compared to Builder Plus and NodeOps. And remember, BTCS is a microcap. High growth potential, absolutely, but also significant risk. Their market cap swings wildly. We saw it between, $44 million and nearly $100 million in just a few months in mid-2025. Very volatile. But here's the kicker. Despite being small, their Builder Plus apparently captured a 2.7% market share of all Ethereum network transactions in Q2 2025. Now, for a company of this size, that 2.7%, that's actually pretty significant.
Yeah, that number jumps out. So for you, the investor, the value proposition is basically a publicly traded, operationally leveraged proxy for Ethereum's growth. It's a bet on management pulling off this complex flywheel thing.
And it's a bet on the industry itself, which has massive tailwinds. The blockchain infrastructure market, projections are huge. KGR estimates range from a solid 26% up to 90% through the 2030s. That's a powerful rising tide.
A rising tide lifts all boats, potentially. But what about the sharks in the water? The competition?
Oh, it's fierce. Absolutely fierce. In staking services, you've got giants. Lido dominates with nearly 28% of all staked ETH. Then there's Coinbase, Binance,
Right.
BTCS. They're barely a blip there.
Yeah.
Less than 0.1% market share of staked ETH. negligible.
Okay, so staking isn't where they compete head-on with the big guys.
Not really. But in block building, where the data is sketchier, that 2.7% share of transactions, that's their distinct niche. That's where they're trying to carve out space.
Got it. And then there's the ever-present regulatory risks.
Always. It's a primary risk. The SEC, other agencies, enforcement actions happen, and the big question are these asset securities, commodities, still unresolved. Management themselves are on record hoping for a more, quote, crypto-friendly administration. That tells you something.
Yeah, it tells you they see it as a major factor.
Yeah.
What about barriers to entry? Can anyone just set up shop and do this?
Not easily. There are significant hurdles. First, capital. You need serious money, tens of millions to scale. Just one validator node needs 32 ETH minimum.
That's, what, like $100,000 or more, depending on the price?
Easily. Then there's technology. Building and maintaining high-performance stuff like Builder plus Cell, that's complex, needs constant R&D. Operational excellence is crucial too. Validators need near-perfect uptime. Mess up, and you get slashed, penalized, lose ETH. And finally, trust and reputation. You need big players like MetaMask to send you transaction orders. That takes time, requires a proven track record.
Okay, so not easy to jump in. What about their competitive edge, their moat? Is it just being an early public company?
That's part of their brand, sure, being one of the first public crypto companies, but it's a pretty weak moat, honestly.
Right.
Cost advantages over giants? Not really. But their use of DeFi for borrowing is interesting. Getting capital around 3%, that's cheaper than traditional finance often is for a company this size.
This DeFi angle is clever.
But the most promising potential advantage, network effects in block building. If that MetaMask integration really takes off.
The wallet with 100 million users.
Exactly. That could start a powerful flywheel. More users, more order flow, better data for Builder plus Gate attracts more users.
Yeah. Classic network effect.
And their unique assets. That proprietary Builder plus tech, obviously shown by the market share, their 14,600 ETH treasury is key. And the management team's hybrid expertise knowing both TradFi and crypto, that's valuable.
Okay, but here's where it gets like really interesting and maybe concerning. That 2.7% market share. Bullish signal, right?
Seems like it, yeah.
But then Q1 2025 gross margins just cratered from 75% the year before down to just 7%.
Steep drop.
And management says that's because of the costs of scaling Builder plus Merit.
Correct.
So this creates a massive tension, doesn't it? Was that market share won purely on tech merit? Or did they essentially buy it by operating at a huge loss, basically subsidizing it?
That is the crucial question.
The entire bull case seems to hinge on whether they can turn that impressive market share into an actual profitable, sustainable business.
Precisely. Profitability is the key missing piece right now.
All right. Let's pivot then. Let's move into Chapter 2, management evaluation. Because in a wild industry like crypto, leadership is often everything. So let's unpack the team at the top.
Okay. The executive team, as I mentioned, brings complementary skills.
Yeah.
You've got Charles W. Allen, CEO and chairman since 2014. He's got the investment banking, capital markets background, seen a few crypto cycles.
Experience matters there.
Definitely. Then Michael Handerhan, COO, co-founder. He's the tech and operations guy. Background includes IT consulting for NASA, interestingly enough.
Technical chops.
And Michael Pravosnik, the CFO. He's a CPA. Spent over 9 years at PricewaterhouseCoopers. Absolutely vital for navigating these super complex digital asset accounting roles.
So a blend of finance, tech, and accounting. Seems reasonable. And maybe their biggest achievement, like you said, is just surviving, guiding a micro-cap public company through a decade plus of crypto chaos.
That's definitely an achievement in itself, yes. They're also very communicative, lots of press releases, SEC filings. They put information out there.
Okay, transparency is good.
However, there's a but. A pretty significant one. We looked at the SEC Form 4 filings. Those show insider trades. And they reveal consistent, significant stock sales by insiders throughout 2024 and 2025.
Oh, like who?
Key examples. April 2025, CEO Charles Allen sold 200,000 shares. May 2025, COO Michael Handerhan sold 150,000 shares.
Wow. Okay, so the top guys are selling fairly large chunks of stock.
Exactly. And this creates a fundamental contradiction, right? Management is out there promoting this bold, bullish growth strategy, the flywheel, acquiring ETH. But the key executives are reducing their personal holdings. That disconnect. That's probably the single biggest red flag in our entire analysis.
Yeah, that's tough to ignore. Actions speak louder than words sometimes. So how are they allocating capital generally? Seems focused on organic growth, buying ETH mainly, and they announced that plan to raise $100 million.
Correct. Primarily focused on acquiring ETH to fuel the flywheel. And that $100 million raise uses that hybrid model we touched on. There's ATM equity sales, selling new shares into the market. That's highly dilutive to existing shareholders.
Dilution, okay.
Convertible debt also carries potential for significant dilution later on.
Right.
But critically, there's the OV DeFi loan. That's collateralized by their ETH, has a really low net cost, around 2.78% annually, and importantly, no dilutive impact. They've already drawn down their full authorized amount there, which was $4.0 million.
So when management claims they're minimizing dilution, that's only partially true, isn't it? Because they are using ATM sales, which are definitely dilutive.
Precisely. It's a mixed bag. They're using non-dilutive DeFi, which is innovative, but also relying on traditional dilutive methods. So minimizing is maybe a bit of spin.
Okay. And capital return, buybacks, dividends.
Nope. BTCS is a capital consumer, not a returner right now. No history of share buybacks. And that famous dividend, the Bitcoin dividend back in Jan 2022, that was a one-off marketing stunt, really, not the start of a regular policy.
So no dividend paid, none expected.
Correct. And return on invested capital, ROIC. It's deeply negative. One source we saw calculated a trailing 12-month ROIC of negative 543%.
Minus 543%.
Yeah, those figures just hammer home that the operating losses are huge relative to their small capital base.
Okay, let's really get into those numbers now. Time for Chapter 3. Financial analysis. The financials, from what we've seen, paint a picture of a company in, let's say, a high-stakes transition. Volatile growth, persistent unprofitability.
That sums it up well. Looking at the financials, revenue growth is just erratic, all over the place. $1.2 million in 2021, then up to $4.1 million in 2024. Q1 2025 saw that big 274% jump year over year, but then it dropped 27% from the prior quarter, Q4 2024.
So super volatile. Tied directly to crypto prices, presumably?
Absolutely. That volatility is a direct result of their revenue being linked to crypto prices, especially ETH.
And what about that weird $7.8 million net income in 2023? That wasn't from operations turning profitable, was it?
No, not at all. That was almost entirely driven by non-cash changes in the fair market value of their crypto holdings, basically. The price of ETH going up on paper. And a new accounting standard helped, too.
Accounting changes and asset appreciation, not core profit.
Correct. And as a microcap, the market cap itself is incredibly volatile. $44 million to $99 million in just a few months, mid-2025. Closed around $2.48 on July 8th, our analysis date.
Profitability, though. That seems to be the Achilles heel. That Q1 2025 gross margin plummeting to 7%, down from 75% the year before.
It's a stark decline. And management pointed directly to the costs of scaling Builder plus F.
So their main growth driver, Builder plus F, is currently unprofitable on a gross basis. Never mind operating or net.
That's the situation right now, yes. Operating and net margins are consistently deeply negative.
And cash flow.
A long, unbroken history of negative free cash flow. They consistently burn more cash than they generate from operations, which is exactly why they have to keep raising external capital, selling stock, taking loans just to fund operations and growth. There's just a complete lack of earnings consistency.
Okay, cash burn is the norm. What about financial stability?
Debt. On paper, their debt-to-equity ratio looked amazing, right? Like 0.02 as of March 31st, 2025. Super safe.
Looks incredibly safe on a standard screener, yes. But it's misleading. Terribly misleading for this kind of company.
Because that ratio doesn't properly account for their DeFi borrowing. They've drawn $4 million in stablecoin loans from Avo, collateralized by their ETH. That carries significant risk. Specifically, automated liquidation risk. If the value of their ETH collateral drops sharply, poof, the protocol automatically sells their ETH to cover the loan.
No warnings, just gone.
Exactly. Code is law in DeFi. So you really need to watch their self-imposed 40% net asset value leverage cap. That's a key risk metric they set themselves.
Okay, so traditional debt ratios are deceptive. What about liquidity? Their current ratio looks sky high too, like 43.43. Loads of liquid assets.
Again, misleading. Looks fantastic, but what are those current assets? Overwhelmingly, it's staked crypto, mainly ETH.
Which isn't like cash in the bank?
Not at all. It's subject to extreme price volatility, and there are unstaking periods you can't always access it immediately. So their true day-to-day liquidity, the cash they can actually spend easily, is much, much tighter than that 43.43 ratio suggests.
So the big takeaway here for you, the listener, is critical. Standard financial screeners. Ratios like debt to equity, current ratio, they can be actively deceptive when analyzing companies with crypto-heavy balance sheets. Don't trust them blindly.
Absolutely. You have to dig deeper. Now, valuation. Price to earnings, PE, meaningless with negative earnings.
Yep.
Price to sales, PS, we saw it reported as high as 9.14, even 11.1 on a trailing 12-month basis.
That seems high for a company losing money.
It's very high. It indicates the market is pricing in a tremendous amount of future growth and, crucially, future profitability that just isn't there yet.
So how do you value something like this? Analysts use a discounted cash flow, a DCF model, right?
They try. But for BTCS, a DCF is exceptionally challenging. Why? Because they aren't generating positive cash flow now. So the entire valuation becomes dependent on making really aggressive assumptions about a distant, highly uncertain, profitable future. It's more guesswork than calculation sometimes.
What are the make-or-break assumptions in a DCF then?
Two critical ones. First, the growth rate. You'd have to assume very high, sustained revenue growth for many years, maybe using those big market CAGR numbers, 26% to 90% as a guide. And, just as importantly, you must assume a dramatic improvement in profitability. Gross margins going way up, operating margins turning positive and growing significantly. A huge turnaround.
So massive growth and a massive profitability turnaround.
Exactly. Second, the discount rate. Given the extreme risk profile, the volatility, the regulatory uncertainty, the operational risks, you need a very high discount rate. Easily in the 30% to 50% range, maybe even higher. You see that for early-stage crypto ventures. Their stock beta of 1.12 confirms it's more volatile than the market average, supporting a higher rate.
So ultimately, running a DCF here isn't about finding a precise target price. It's more about understanding the sheer scale of the leap of faith required, right? What needs to go right to justify even today's price?
That's a perfect way to put it. It quantifies the hope baked into the stock price.
Okay, let's move into the second part of our analysis. Let's start with Chapter 4. Market sentiment. How is the market actually viewing DTCS right now?
Well, formal analyst coverage is very thin, pretty typical for a microcap stock like this. The consensus rating, if you can call it that, is a strong buy, and the average one-year price target is somewhere around $5 to $5.10.
A strong buy. That sounds bullish. But you said coverage is thin?
Extremely thin. It looks like that consensus is basically based on the research of just one firm, H.C. Wainwright & Co.
Ah, okay. So not exactly a broad agreement among analysts.
Not at all. This lack of broad coverage creates potential information asymmetry. You know, some people might know more than others, so you have to weigh that $5 target accordingly. It's one firm's opinion, essentially.
Got it. And the general narrative, the story being told about BTCS recently.
Overwhelmingly positive, really. And it's been driven almost entirely by a steady stream of bullish press releases from the company itself.
Like what?
Key things they've highlighted. That strategic plan to raise $100 million to buy more ETH. The huge partnership with MetaMask for order flow. Achieving that 2.7% market share in block building. And their own guidance for all-time record revenue coming up.
So a constant drumbeat of good news from the company.
Exactly. And that's created a positive media tone. And it's definitely correlated with sharp upward moves in the stock price. Good news comes out, stock goes up.
But.
Yeah.
There's always a but, isn't there? Despite the positive news, are people betting against it? What's the short interest look like?
There's definitely a significant contingent betting against it. Short interest as a percentage of the float the shares available for trading has been reported in a range of 3% up to about 8.4%. One specific report showed 1.11 million shares short, representing 7.89% of the float. And based on average trading volume, it would take over 6 days for those shorts to cover their positions.
6 days to cover. That's pretty high. It means a lot of conviction from the short sellers.
It does. This level of short interest really frames BTCS as a classic battleground stock. You've got the bulls excited by the press releases and the potential, and the bears looking at the financials, the risks, the insider selling.
A clear divergence of opinion.
Absolutely. And that tug of war between the bull thesis and the bear thesis is a primary driver of the stock's extreme volatility.
Makes sense. What about technicals? Chart patterns?
From a technical analysis perspective, as of early July 2025 when we looked, the stock had been showing bullish momentum. It was trading above both its 50-day moving average, around $2.29, and its 200-day moving average, around $2.24.
So technically the trend was up at that point?
Yes. For now, it seems the bullish narrative fueled by the company's news was winning the sentiment battle. But it's clearly a fragile situation given the underlying financials and the short interest.
Okay, a battleground stock indeed. Let's shift focus now to Chapter 5. Ownership structure. Who actually owns this company? That tells you a lot about confidence and alignment.
Right. And the ownership structure here is, well, Pretty revealing. It's heavily skewed away from institutional investors. Insiders own a big chunk, approximately 37.7%. The CEO, Charles Allen, is the largest individual holder with over 4 million shares.
Okay. High insider ownership. That can be good, right? Skin in the game.
It can be, but hold that thought. Institutional ownership, on the other hand, is exceptionally low, somewhere between 3.2% and 5%. Very, very low for a public company.
Only 3 to 5% held by institutions. Wow. Why so low?
Well, if you dig deeper into which institutions own it, it gets even more interesting. The largest holders are often passive index funds, like the Vanguard Total Stock Market Index Fund.
Index funds. So they don't own it because they actively chose BTCS.
Exactly. That's a critical distinction. These funds don't own BTCS because some portfolio manager did deep research and decided it was a great investment. They own it simply because their mandate is to own a tiny piece of the entire market, and BTCS happens to be in that market index.
So the fact that there's almost no active institutional managers, people making a high conviction bet on the company, that sends a pretty powerful signal, doesn't it?
It sends a very powerful signal. It suggests that the professional money managers, the ones paid to pick winners, are largely staying away.
Okay, back to the insider ownership. 37.7% is high, usually seen as alignment.
But, as we discussed in the management chapter, that potential alignment is seriously called into question by the recent pattern of transactions. Both the CEO and COO engaged in consistent, significant selling throughout 2025. That stands in stark contrast to the bullish strategy they're pitching publicly.
Yeah, the selling really undercuts the skin in the game argument.
It does. So, you have insiders owning over a third of the company, which gives management huge control over strategy. Good or bad, they're in charge. But combine that concentration of control with the insider selling, and it creates a high-risk governance profile. The interests of the controlling insiders might not perfectly align with the interests of the public retail shareholders who own most of the rest. That's a crucial point for anyone considering an investment. Whose side are management really on? All right, let's wrap things up with a formal look at the dangers. Chapter 6. Risk assessment. We'll use a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Sounds good. Let's start with strengths. These are the core internal competencies, what they do well. First, they are an early mover and survivor. Being public and operating crypto for over a decade shows resilience. That's worth something.
True.
Second, technical expertise. They've proven they can operate complex blockchain infrastructure, shown by that builder plus market share. Third, strategic focus. They have a clear, albeit risky, Ethereum-first strategy, at least they know what they're aiming for.
Yeah, folks, is good.
And fourth, significant ETH holdings. That treasury of 14,600 ETH isn't just sitting there, it's a core strategic asset used in their operations.
Okay, those are the positives from within. Now, the weaknesses, internal limitations.
Number one, clearly, unprofitability and cash burn. That long history of losses and negative free cash flow means they have to rely on external capital. Constant need for money.
Second, shareholder dilution. There's a history of it, and it's set to continue with that $100 million capital raise plan involving ATM sales.
Your shares get worth less over time.
Potentially, yes. Third, insider selling. We've hit this hard, but it's a major weakness. It undermines confidence, raises alignment questions.
Big red flag.
And fourth, high volatility and microcap status. This just isn't a stock for the faint of heart or anyone with a low risk tolerance.
Definitely not widow and orphan stock. Okay, weaknesses covered. What about opportunities? The external potential.
Well, the biggest one is simply the growth of the Ethereum ecosystem. If Ethereum keeps growing, like many expect, demand for infrastructure services like BTCS offers should grow right along with it.
Riding the wave.
Second, scaling builder plus FIA. There is a huge opportunity if they can grow that 2.7% market share and figure out how to make it profitable. That's the key.
For profitability challenge again.
Third, the network effect flywheel. That MetaMask partnership could be the catalyst for a really powerful, defensible moat if it works out.
Huge potential there.
And fourth, innovative DeFi financing. Their ability to tap into low-cost, non-dilutive capital from protocols like A5. That could be a sustainable financing advantage if managed carefully.
Okay, opportunities exist. Finally, the threats. External challenges they face.
Top of the list. Intense competition. Lido, Coinbase, other block builders.
Yeah.
It's a crowded space with powerful players.
Hard to compete.
Second, technological obsolescence. Blockchain tech moves incredibly fast. Some new protocol, some new scaling solution could pop up and make their builder plus advantage irrelevant overnight.
Constant innovation risks.
Third, Regulatory crackdown. Always a major threat. Unfavorable rules on staking, DeFi, or even how Ethereum itself is classified could severely hurt their business model.
The regulators hold a lot of power.
And fourth, network integrity. It's low probability, but a catastrophic failure or hack of the Ethereum network itself, that would be existential for a company betting everything on it.
Right, a black swan event for Ethereum.
And we also have to consider broader macroeconomic factors. BTCS is a high-risk, long-duration growth asset. That makes it super sensitive to things like rising interest rates. Higher rates make future hypothetical profits worth less today.
Risk-off environments hurt them too.
High inflation, economic uncertainty. Investors flee speculative assets like this during those times.
And it's not just theoretical. We saw a real-world example, right? With the U.S. imposed tariffs of 2025. Seemingly unrelated to crypto.
Exactly. Those tariffs created global economic uncertainty, triggered a broad risk-off move in markets. Investors sold speculative stuff, including crypto, and BTCS, in their own Q1 2025 report, specifically cited tariff-related macroeconomic uncertainty as a key reason for the crypto pullback that hit their results.
So it just proves the point. The idea of crypto being decorrelated or a safe haven, that hasn't really panned out.
Not consistently, no. For valuation purposes, you have to treat companies like BTCS as highly sensitive risk assets. They're deeply tied to global macro and geopolitical shocks. And that reality fully justifies using a high equity risk premium, a high overall discount rate, when you try to value the business. The risk is simply higher.
Okay, that paints a comprehensive risk picture. Let's bring it all together now. We've reached Chapter 7, Conclusion. Let's synthesize our findings into the core bull and bear arguments for BTCS.
All right. The bull case for BTCS, the argument for investing, really rests on 4 key pillars, as we've discussed. 1, it offers a unique, operationally leveraged investment in Ethereum's future, a way to play ETH's growth with operational juice.
More direct than just holding ETH.
2, they've established a proven niche and potential network effect in block building. That 2.7% market share in the MetaMask deal are tangible evidence. 3, their innovative flywheel strategy and experienced management team represent a novel approach to growth and raising capital in this space.
Not something different.
And 4, the whole thing is underpinned by that massive secular tailwind, the projected growth of the entire blockchain infrastructure market.
Okay, that's the optimistic view. But the bear case, the argument against investing, is equally compelling, isn't it? Rooted in some fundamental weaknesses and big risks.
Absolutely. The bear case points to 1, the company is fundamentally unprofitable, a long history of losses, negative cash flow, and those recently terrible gross margins.
Can't ignore the red ink.
2, the pattern of insider selling. Top execs selling shares is a major red flag, directly contradicting the bullish public story.
Actions versus words again.
3, the extreme risk profile. Intense competition, regulatory threats, tech obsolescence, the volatility of ETH itself. It's a highly concentrated, high-risk bet.
Lots of ways things could go wrong.
And 4, growth has been funded by a history of shareholder dilution, and that looks set to continue. Your slice of the pie keeps potentially shrinking.
Okay, bull versus bear laid out. What about valuation in the end? We talked about DCF being speculative.
Right. A traditional DCF valuation for BTCS is really an exercise in seeing what needs to be believed. Because there's no history of profit, any valuation hinges entirely on assumptions about a distant, uncertain future. Our educational DCF models just show that to justify even the current stock price, $2.48 as of our analysis date, you have to plug in aggressive multi-year revenue growth and a dramatic, completely unproven expansion in profit margins.
A very wide range of possible outcomes.
Exceptionally wide, which just underscores the high degree of uncertainty here.
So as of July 8, 2025, with the stock at $2.48, it seems to sit in a pretty precarious spot. It's way below that single analyst target, around $5, a price that seems to require the bull case unfolding almost perfectly. For someone who truly believes in Ethereum's long-term dominance and believes this management team can execute this complex strategy flawlessly, maybe $2.48 looks deeply undervalued.
That would be the bull perspective, yes. A potentially huge payoff if everything clicks. However, that formidable list of bear factors, the unprofitability, the insider sales, the competition, the regulatory risks, suggests substantial downside remains. If that flywheel strategy sputters or fails to become profitable soon, the stock could easily fall much further.
So ultimately, BTCS looks like a classic high-risk, high-reward venture. It's right at the cutting edge of finance and technology. The outcome is absolutely far from certain. So a question for you listening is, What stands out to you? How do you weigh that allure, that leverage play on Ethereum's future against the very tangible, very significant risks we've explored today? Lots to think about there. And that brings us to the end of this deep dive into BTCS Inc. Thank you so much for joining us. Remember, if you found this valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And members, you can add stock suggestions for future deep dives right there in the comments, and we will absolutely pick them up. For just $4.99 a month, members get priority deep dives on tickers. And over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those. If you just want a one-off deep dive on a stock you're interested in, dropping us a super thanks is a great way to do that too.
And as always, please remember this important disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be considered financial advice. Please always conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Absolutely. Until next time, keep learning and keep diving deep.